Welcome everyone to this live broadcast of Manufacturing Talk Radio. I'm Tim Grady. I'm here with my co-host Lou Weiss, and we're talking today with Cliff Waldman, who is the CEO of New World Economics. He's just come out of a meeting with Fed Chair Jerome Powell, talking about the interest rate hikes and what that could mean both in the U.S. and how the U.S. reacts to what things are happening globally, including the war between Ukraine and Russia. Cliff, thank you for joining us. We appreciate you being at the meeting in Washington, D.C. Give us an update on what took place.
Well, it's my pleasure. I just got out of listening to Chair Powell. It was quite a crowded room, quite an event. Fed chair have gotten, their share of being made fun of for opaque language, particularly since the 1990s. But in my many years of following Fed chair, I would say that Chair Powell is the most transparent. Yeah, he tends to use very little opaque language, and he just speaks in very direct terms. And this was a hard-hitting speech. He is not mincing words that inflation is much too high, that we need to bring it under control, and that there are a number of risks to the outlook. That the fact of bringing inflation under control, which is going to have to require a quick and potentially aggressive monetary policy, is a risk for the short-term outlook of the economy. And you add to that a global situation that most of us have not seen the likes of which in our lifetime. We have a dangerous and globally disruptive war in Ukraine that is creating both inflation risk globally because it's disrupting commodity supply and thus commodity prices. We've all seen oil and gas prices spike, and it's creating reverberation uncertainties which could very well slow the global economy and thus create a risk to the U.S. economy. Powell, addressed the fact that, there is some historical precedent, some historical encouragement for a soft landing when it comes to monetary policy. And by a soft landing, we mean the Fed bringing inflation under control without tipping the economy into a serious slowdown or even into a recession. But even after saying that, he acknowledged the risk. So, we have a Fed chair who knows what the priority is. It is most likely that we're going to get a quarter-point interest rate hike at each of the Federal Open Market Committee meetings for the balance of this year. But as he said a number of times, it's not a preordained path. Every meeting is a live meeting. Every meeting they're going to have to look at the data and look at what's going on in the world. Thus, it is possible that if inflation really gets worse, doesn't respond the way that they want, well, they may have that quarter point could be 50 basis points. They're not taking anything off the table when it comes to inflation. At the same time, we have a difficult and humanly horrendous situation in Ukraine, which is already disrupted supply lines, creating massive uncertainty, which could create the conditions for a global slowdown and thus a risk to the U.S. economy. So they are, the middle of the road forecast of a quarter-point interest rate hike at every one of the every 6 weeks FOMC meeting. That's the median forecast, but the pull from both sides of that to possibly doing 50 basis points, given that we have a very difficult inflation picture, or holding off, given that we have a hugely risky global scenario from Ukraine and Russia, and still great uncertainty with the pandemic. I mean, China has been closing down some of its largest cities. Shenzhen, I believe, is a city of about 18 million people. They're locking it down because of COVID. That in itself will act to disrupt already disrupted supply chains coming out of China and often extending around the world. So he didn't mince words. It's a difficult inflation picture, and there's a great number of risks surrounding the world in which they are trying to control U.S. inflation.
So, Cliff, how do you feel about this?
I think he's dead on. I think I began to worry about inflation earlier when inflation showed up, late fall winter 2021. There was some risk of calling it transitory, because the reason that it showed up, most of the inflation comes from the fact that there was a huge demand resurgence as we were starting to come out of the pandemic, partially fostered by large government stimulus, government checks coming in, and we had a very constrained supply because supply chains were very gummed up by the pandemic and everything that it affected, mainly labor supply. So at that point, inflation could have been transitory if we acted more quickly on it. But it got out of control, and now I too am alarmed by the inflation picture. It is the highest inflation in 40 years, and the possibility of it getting worse and just in itself tipping the economy into a slowdown recession is there. So I agree with him on that. The war in Ukraine and all the risks that surround it, economically and even geopolitically, are creating a set of risks. There's the obvious ones of big jumps in commodity prices, making an already difficult inflation picture even worse, and then creating such global uncertainty, but particularly in Europe, but not just in Europe, that it could slow the global economy down. I agree with. I found myself in complete agreement with what Chair Powell was saying about the need to quickly get on inflation and the risks surrounding the year that they're going to take to really try to bring demand in line with supply. I agree with what he says. I agree with his assessment today.
So, from a global perspective, I appreciate your commentary. Here in the U.S., with regards to manufacturing, which is
right.
Near and dear to our hearts,
right.
How is that going to affect us? Because manufacturing, according to the Institute of Supply Management, is, and according to whatever it's worth, the All Metals and Forge Group sponsor of Manufacturing Talk Radio, is that it's things are improving, things are growing, things are hot. Deliveries and regards to shipping and logistics is very bad. So it's almost like the more business you do, great. How are you going to ship it? How are you going to deliver it? Because we have other issues. So with regards to that, can you make some commentary for the sake of our audience with regards to the fact that manufacturing is so much part of our economy?
Well, all right, now we need to put manufacturing in the context of what Chair Powell said today and in my agreement with Chair Powell. Let's first remember it is easily, by a mile, the most globalized sector of the United States economy. About 65% or so of U.S. manufacturing output is sold overseas. So the global economy affects U.S. manufacturing as much, if not more, than the U.S. Economy. It is, and it is, when I talk, the things that I've been talking about, commodities, oil, natural gas, those kinds of things, ammonium that, is a big export for Russia and Ukraine. Those are all things that go into manufacturing processes. So, and finally, there's never been, and this one I want to be careful about because what the research has shown, manufacturing is the most capital intensive of all our sectors. It grows when manufacturers, have confidence to sort of add capital to their sectors. Now, there's never been shown to be that much of a relationship between interest rates and capital spending, and nor capital spending in manufacturing. But I really believe that with the pace that interest rates are going to have to increase, even under the best of circumstances in this coming year, interest rates are going to affect the very capital, are going to have some effect. Just in my gut, tell me are going to have some effect on capital intensity in manufacturing. So to sum up what I just said, it's a trouble. I described the risks of a difficult on knife's edge world now, and reminded everybody that U.S. manufacturing is the most globalized sector, is the most affected by global forces of any sector in the United States economy. And generally speaking, if the worst happens, and they have to, and the Federal Reserve has to really move quickly on interest rates. And let's say the worst happens, they bring inflation under control, but it's at the expense of either a serious slowdown or even a mild recession in the U.S. economy. Manufacturing tends to generally move with the economy. So even if it's not, the interest rates aren't hitting capital spending and other variables in manufacturing directly, if they tip the United States economy into a big slowdown or even a recession, just by derivative, the U.S. manufacturing is going to be affected. So we are in the U.S. manufacturing sector, which certainly had a terrific recovery from the pandemic, a faster and better recovery from the pandemic than was the case during the in the aftermath of the financial crisis. Yes, it's strong, but it's with everything that's going on right now, supply chains, Ukraine, Russia, interest rates, risks to the overall economy, manufacturing is directly in the line of fire, unfortunately.
Cliff, I'm just curious, do I understand that correctly, that these increases in the rate, the Chairman Powell expects to bring inflation down to 2% over the next 3 years?
Well, he wants. First of all, we all know that, as Milton Friedman taught us, that monetary policy works with a lag, with long, quote unquote, long and variable lags. So he wants to bring inflation down to about 2%, although with the Fed's new framework, I think they're going to allow it to, to be a little more flexible than was the case previously, to be maybe somewhat above 2% as circumstances warrant. Yeah, but yes, I think the general benchmark for what they want to do is to bring inflation down to 2%. Again, nobody's going to give an exact benchmark. Things are just too uncertain. But certainly, I think what they're hoping for is by, let's say, the middle of next year, that we see the economy on at least if not there, but at least on a glide path to 2% inflation. Then they will say that the policy that they're starting to implement right now has been successful. Mid 223, we're on not there, but maybe a glide path to 2.5% inflation. That would constitute a successful policy.
In the meantime, the wage gains evaporate that we've seen over the last 2.5 years. Is that true?
Well, the wage gain. I think you want to deal with the wage gain. Yes, unfortunately, but particularly the wage gains right now. We've seen compensation spikes, and that's due to labor market shortages. I mean, job openings are hitting record levels, and the employers are going begging for jobs. But as a result, as you would expect, wage gains are there, compensation gains are there, but they haven't been enough to compensate for the roughly 7, depending on how you measure it, 7% or so inflation. I mean, they've been getting good wage gains, 3-4%, but when inflation is running at 7%, doesn't do you much good.
Behind the numbers,
Yeah, they're going to operate a little behind the eight ball. I know they're playing a little bit of catch up. In the overall, and I appreciate, Cliff, that you are comfortable with what Chair Powell is presenting. It seems like we all knew that they had to increase rates. The
Yes.
question is, will they be successful? The big unknown. They don't know. We don't know. I guess this is just one that we're going to have to ride out. Fingers crossed.
It is. There's I mean, they're landing a spaceship amidst a lot of turbulence. That's the situation.
Yeah, no doubt. Cliff, anything else you want to add to this as we begin to wrap this up? And we appreciate you reporting right from the conference itself in Washington, D.C.
It was my pleasure. I think it's a risky time for the economy. I would say that to end on a positive note, we saw how the U.S. manufacturing sector got really pummeled in the financial crisis of 2007 to 2010. Was slow to come back, but it came back remarkably well in after the initial 5 or 6 months of the pandemic. And the U.S. economy has, we lost 20 some odd million jobs in the first couple of months of the pandemic, something that's going to be part of the history books for generations to come. But we came back. So the U.S. economy and the U.S. manufacturing sector have been, even through all this tumult, even through these very difficult years, which never seem to stop being difficult, have shown their strength. They've shown what they can do. If we can get through this period, if we can bring inflation in line without too much damage to the economy, and then just deal as best we can with external factors that we can't control, like COVID showing up again, and this horror story in Ukraine, which we all pray to end. Then our future beyond this storm and this very tricky time, looks good, because we've seen the underlying persistence of both the U.S. manufacturing sector and the U.S. economy. So that too has to be factored into the picture to get everybody to look beyond what's going to be a very tough year and a half or 2 years.
Cliff, your analysis and your insight is better than what we could expect on mainstream media. And I really appreciate that. And I hope I'm not pissing anybody off, but you got it down to a science. And I really appreciate it. Tim?
Thank you. My pleasure to do this. Thank you.
Thanks for joining us, Cliff.
Thank you very much. Have a good afternoon. Bye-bye.
And we've been speaking with Cliff Waldman, who is the CEO of New World Economics, as he reports from Washington, D.C., and the National Association for Business Economics event, at which Fed Chair Jerome Powell just completed his presentation to that group. We appreciate you listening to this episode. If you'd like to hear more of our episodes, please go to jacketmediaco.com, where you can find this podcast and the others that we produce. And thanks for joining us in this special live event.